In this video we talk about how rupee value calculated, why rupee losing its value, its impact on country and how we can improve. The Indian rupee has been losing value against strong currencies like the dollar in recent years, which has caused concern about how this will affect the country's economy. When the rupee loses value, it makes imports like oil more expensive, increases inflation, and can impact people's cost of living. The reasons for this drop in value include both issues within India, like higher prices and a gap between imports and exports, as well as global factors, like changes in oil prices and uncertain world events. Understanding why the rupee is losing value helps us see how it can affect the economy, businesses, and everyday life in India. Before 1947, the Indian rupee was controlled by the British and influenced by their policies, as well as major global events. In the early beginning of 16th century, the Indian rupee started as a silver coin called the Rupee, introduced by ruler Sher Shah Suri. This coin was widely used in India and eventually became the foundation of the rupee. When the British East India Company took control, they made the rupee the main currency. It was based on silver, unlike the British pound, which was based on gold. This would later cause problems for the rupee. In the 1870s, most major countries adopted the gold standard, where currency was tied to gold. India's rupee was still tied to silver, which was losing value compared to gold, making the rupee weaker. To fix this, the British pegged the rupee to the pound in 1898. During World War I, Britain needed money for the war. They left the gold standard and printed more money, causing the rupee to lose value and prices to rise in India. The global economic crisis in 1929 hurt currencies worldwide. Britain once again left the gold standard, and since the rupee was tied to the pound, it also lost value, causing poverty and higher prices in India. During World War II, the British printed even more rupees to fund the war, causing the currency's value to drop even more. This created inflation, making everyday goods more expensive in India. By the time India became independent in 1947, the rupee had been weakened by years of British control, wars, and global economic crises, leaving India with many challenges in managing its currency. The value of the Indian rupee, like any currency, is determined by several factors and methods. The value of the rupee is influenced by how much people want to buy and sell it. India uses a managed floating exchange rate system. This means that while the value of the rupee is largely determined by market forces, the Reserve Bank of India can intervene to stabilize it when necessary. The RBI may buy or sell rupees in the foreign exchange market to prevent extreme fluctuations. Several economic factors affect the value of the rupee, including, if inflation in India is higher than in other countries, the value of the rupee may decrease. Higher interest rates in India can attract foreign investment, increasing demand for the rupee and potentially raising its value. A trade deficit importing more than exporting puts pressure on the rupee, as it increases the demand for foreign currencies. The value of the rupee can also be affected by global events, such as changes in oil prices, geopolitical tensions, and shifts in investor sentiment toward emerging markets. If investors are more confident in the Indian economy, the value of the rupee may strengthen. NER is an average of the exchange rates between the rupee and the currencies of India's major trading partners, adjusted for trade weights. RER is similar but adjusted for inflation differences between countries, giving a better picture of the rupee's purchasing power. The value of the Indian rupee is determined by a combination of market forces, economic indicators, government policies, and global conditions. The interaction of these factors leads to fluctuations in the rupee's value in the foreign exchange market. Now we look why it's losing its value. The Indian rupee's value, like any currency, fluctuates due to a range of economic factors and is often measured against the dollar or other major currencies. When India imports more than it exports, it creates a trade deficit. Higher demand for foreign currencies relative to the rupee leads to depreciation. For example, India imports large quantities of oil, which must be paid for in dollars, putting pressure on the rupee. Higher inflation rates in India compared to other countries can erode the value of the rupee. Inflation reduces purchasing power, making a currency weaker relative to others with lower inflation. Central banks, like the Reserve Bank of India, set interest rates to control inflation and influence economic growth. Lower interest rates make the rupee less attractive for foreign investors, leading to capital outflows and depreciation. Foreign direct investment and foreign portfolio investment bring dollars into the country. If foreign investors withdraw funds, it creates pressure on the rupee. A high level of national debt can make a currency less attractive. As investors worry about the country's ability to repay, they might sell off assets in that currency, weakening it further. The value of the Indian rupee has a wide range of impacts on various aspects of the economy, businesses, and everyday life. Here are some of the key impacts of the rupee's value. A weaker rupee makes imports more expensive, particularly for essential goods like oil, machinery, and electronics. This can lead to increased prices for consumers, contributing to inflation. Rising prices due to a depreciating rupee can reduce purchasing power, making it more difficult for households to afford basic necessities. Ratings. The government may find it more challenging to manage its foreign debt obligations, impacting fiscal policy and public spending. A strong rupee can reflect a healthy economy, potentially supporting growth. Conversely, a weak rupee may hinder growth if it leads to inflation and reduces consumer spending. Fluctuations in the rupee can affect business confidence, impacting decisions on investment and expansion. A weaker rupee can attract more foreign tourists, as their money goes further in India, benefiting the tourism industry. Conversely, Indian travelers may find it more expensive to travel abroad, reducing their purchasing power and travel frequency. Changes in the rupee's value can influence public sentiment regarding the economy. A depreciating rupee may lead to concerns about economic stability, while a strong rupee may boost confidence. Overall, the value of the Indian rupee plays a crucial role in shaping the economic landscape of the country. Its fluctuations can have both positive and negative consequences across various sectors, affecting everything from inflation and trade to investment and consumer behavior. Understanding these impacts is vital for policymakers, businesses, and individuals navigating the economy. How can we improve? Yes, India can improve the value of the rupee and enhance its overall economic stability through various strategies and reforms. Here are some actionable steps that can be taken. Simplifying the tax structure and improving tax compliance can increase government revenue, allowing for better public investment and economic stability. Reducing unnecessary regulations can encourage business growth and attract foreign investment. The Reserve Bank of India can focus on controlling inflation through effective monetary policy. Maintaining price stability will help preserve the rupee's purchasing power. Carefully adjusting interest rates to balance growth and inflation can help stabilize the currency. Improving the quality of Indian goods to meet international standards can increase exports. Support for research and development can help innovate products. Expanding market access through trade agreements can open new avenues for Indian products. Establishing a transparent and consistent regulatory framework can build investor confidence, encouraging long-term foreign direct investment. Providing incentives for sectors that can attract foreign capital can stimulate economic growth. Enhancing transportation, logistics, and digital infrastructure can reduce costs for businesses, improving productivity and economic output. Developing smart cities can boost urban development, attracting investment and talent. Supporting local manufacturing can reduce dependence on imports and help balance the trade deficit. Investing in skill development programs can create a more skilled workforce, benefiting various industries. Creating policies that encourage non-resident Indians to invest in India can strengthen foreign exchange reserves. Encouraging the use of local products and reducing reliance on imports can help improve the trade balance. Expanding into new product categories can reduce dependence on a few key exports. Building strong relationships with other countries can create trade opportunities and stabilize the rupee through increased foreign exchange inflows. Engaging in trade agreements can facilitate smoother trade and improve the overall economic environment. Improving the value of the Indian rupee is achievable through a combination of strategic reforms, investment in key areas, and fostering a stable economic environment. With the right policies and initiatives, India can enhance its economic resilience and improve the rupee's value over time.